Joining us here on set, Jeff Rosenberg, BlackRock's systemic fixed income portfolio. Jeff, great to have you with us.
Great to be here.
She also seemed to say, she could see the next move, a scenario in which the next move will be a hike, and that inflation will likely remain higher for longer. Do you agree with that? And how does that sort of influence how you think about what the Fed does?
So I think a lot of it remains to be seen. If you look inside the data today, it was actually a little bit better in the details. When people updated the more important inflation number, which is core PCE, you saw some of those numbers come down. That's why you didn't see a big reaction in the bond market. CPI yesterday was the bigger news, but again, that was a little bit overstated because of the shutdown and the impact that it had on shelter. So there's a lot of things we in the bond market are looking through here, and there's a lot of potential. Actually, this could be the peak in terms of inflation, and inflation could be coming down. Now, that's an if. But what Susan Collins and others are saying is we don't really know what the path of inflation is going to be. We don't have a great track record in predicting it. But to the extent that you don't have these kind of increases that the headlines are pointing to, the underlying core measures are looking a little bit better. Tariff inflation is coming off. The big uncertainty is the pass-through from the headline in oil. We don't know that. But if you're at the peak, then the Fed's not going to be cutting rates, but they don't necessarily have to hike. And that's why you see such a little percentage that you just highlighted there.
So outside of what the Fed might do, what is implied in the way the bond market is priced right now? Inflation expectations, market-based expectations have been going higher. From what you just said, it would seem as if you think maybe yields are capped around here and therefore you want to buy.
So it's about short term versus longer term. And the short term is going to react to the headline inflation. So when you're looking at things like 2-year or 5-year parts of the curve, that's going to be pricing in the impact of headline. But longer term inflation is about core. Core inflation is a little bit better behaved. The issue for yields is, on the long end, much more a different story. And it's about the need for debt financing. We see it from AI, from energy, from global resourcing. All of that is increasing the amount of fiscal deficits around the world. And so that's about the term premium going up for longer-term interest rates. Short-term interest rates are going to be about the path of inflation.
So in terms of the 10-year and the 30-year yield, it sounds like the path is higher. Given what we're seeing in inflation and also global rates around the world and the propensity of other countries and other central banks to hike at this point in the cycle, it seems like is that in the cards, do you think?
I think the difference between the 10-year and the 30-year needs to expand. That's actually been coming in on this inflation surge. So the inflation piece is flattening the curve, but this secular need for financing should steepen the curve. And so we should see that underperformance of the long end relative to the belly of the curve. I think the belly of the curve can be a better spot for investors because you've seen a big increase in interest rates there because of the inflation uncertainty. And to the extent that we're at the tail end of that, then those yields are pricing the right amount of risk, and that's giving you a fair risk return. The back end still has more room to go higher on this fiscal demand piece.
Yeah, you mentioned just all the kind of appetite for capital that's going to have to come out of the bond market one way or another. There's been a lot of celebration at how the corporate market has absorbed the supply so far. Right, a lot of the kind of very well-capitalized large tech borrowers are able to place tremendous amounts. Do you feel like that's at some point going to get to be too much in the way of supply that's going to kind of gap spreads or rates out?
So there's a lot of concern around this maybe a year ago about the financing. The AI trade is coming to the debt markets. A lot of that's gone away as we've seen this just exponential growth in the demand side. And it's really kind of changed people's calculus around whether this supply can be absorbed and the risk premium at which it can be absorbed. There is a ton of liquidity. Credit spreads are very tight. We're in a very good shape as credit markets go, to absorb that issuance. And with the pace of demand kind of taking off some of that tail risk, I think the supply side from the corporate bond is less of an issue than the supply side is for the long end on the fiscal government issuance. The government is a little bit more risky in this market than the corporate bond issuance is, especially when you look at, as your earlier segment did, just the incredible amount of revenues and cash flow that are being generated in that space.
The auctions of late have not been good.
Yeah.
Rick Santelli gave, I think, the 10-year yield auction yesterday, the 10-year auction, a C- or somewhere in the C range, which in my view is not very good at all. And 30-year too.
Exactly. And it's a reflection of that supply-demand mismatch. Now, it's not the end of the world because the price will reset and it will get those auctions to clear. That's the difference in government versus private. Private, you can have a failed auction. You can have a company that can't finance. Governments will find a way to clear, but the price may have to be lower the yield higher in order to attract those investors back in. And that's the point about the term premium increasing there on the back end of it.